So welcome everyone to today's Associates Meeting at SIEPR. For those of you who don't know me, I'm Mark Duggan, the director of SIEPR, and I'm so happy that you could make it out today for our conversation with Kevin Werbach, who will be shedding some light on the technology and implications of blockchain and cryptocurrencies, a topic that I'm sure everyone in this room understands inside and out. Very quickly, though, I just wanted to share a few recent highlights that I'm really proud of here at SIEPR, just shining the light on a few of our recent accomplishments. First of all, I'm really thrilled to share the news that we helped our economics department right next door to recruit Heidi Williams and Dan Fetter from their East Coast institutions. Both have been Trioni visiting associate professors, spending the year with us at SIEPR, and we were able to woo Heidi away from the econ department at MIT and Dan from the econ department at Wellesley College, and so we're very happy about that. And 2 days ago, I was actually at a conference at MIT where I was gloating about this, and afterwards some people came up and said that it was a little too much. So anyway, but I'm an alum, so I can be allowed to do it there. Heidi won a MacArthur Genius Grant in 2015 and focuses on investigating the causes and consequences of technological change in healthcare markets. And Dan's research centers on economic history, public economics, and urban and real estate economics. And I think both of them are going to make really great additions to the economics department as well as to SIEPR. And I really couldn't be happier that they've decided to come out west for good. And I'm especially grateful to Gopi Shah Goda, my partner in crime, deputy director, for all of the work that she put in to help make these appointments happen. I've got some recommendations if anyone is looking for some light reading. So both Hongbin Lee, one of our senior fellows and the director of the China program at our Center on Global Poverty and Development, and I just published articles this week in the most recent edition of the Journal of Economic Perspectives. And as economics journals go, this is about as close as you get to The Economist magazine. Not many Greek letters, not too many impenetrable formulas. Hongbin and his co-authors wrote about the rise of robots in China, and I co-authored a paper on the uplifting topic that looks at the declining well-being of low-skilled men in the US. So you feel free to take a look at those. And I also wanted to make sure you're aware of our upcoming policy forum on May 29th, I think 3 weeks from today, that will examine both the economics of federal budget deficits, kind of an important topic, I don't know, some think it's more important than others, and also the explosive growth in student loan debt over the past decade. So I'm really looking forward to that event, but I don't want to get too far ahead of ourselves because I'm especially excited that Kevin Werbach, my former colleague, is right here. Kevin is a professor of legal studies and of business ethics at my previous employer, the University of Pennsylvania's Wharton School of Business. Kevin was just a wonderful colleague there for me and very helpful to me as I tried to get UPenn's version of SIEPR started and rolling. One of our first collaborations there occurred when he introduced me and my economist colleagues with the director of the FCC, and he expertly moderated a session on innovation at the Wharton version of the SIEPR Economic Summit. He's an expert on the business, legal, and social implications of new technologies like blockchain, which he'll be talking about today. And he's one of the first academics to really dig into understanding blockchain and cryptocurrencies like Bitcoin. And his latest book, which I highly recommend, is called The Blockchain and the New Architecture of Trust. He's been a very influential figure in internet policy. He served on the Obama administration's presidential transition team in 2008. And during the Clinton administration, he helped develop internet and e-commerce policies as the FCC's Council for New Technology Policy. He's also been very successful in the private sector, where he founded the technology consulting firm Supernova Group. So there's really an enormous amount that Kevin could be talking to us about today. And I'm really grateful that he'll be helping us understand blockchain with a lot more clarity. And I have to admit that of all of the topics that I myself have tried to drill down on in my time as SIEPR director, or even before that, understanding this, I think, has been more difficult than anything I've tried to do since I tried to learn Chinese to impress my in-laws more than 20 years ago before getting married. And I failed at that, but I hope I am going to do better here today. So without stealing too much of his thunder, here's what he has to say about blockchain on his website. The wildly misunderstood technology behind Bitcoin and other cryptocurrencies could change business and society as profoundly as the internet did. I see it as fundamentally a new form of decentralized trust. So with that, please join me in welcoming Kevin Werbach to SIEPR, and I'll let him take it from here.
Great. Thank you so much. Absolutely. So delighted to be here. We're still smarting at Wharton about Stanford stealing Mark away from us, but I thought it would be rude to decline the kind invitation to come here and talk to you about blockchain. So it's actually truly a pleasure. I went to the other school here in the Bay Area, but have many great friends here at Stanford and also friends here at SIEPR. Greg Roston was my colleague when I was at the FCC. It's really a great opportunity to come and talk to you about this topic. Because as Mark alluded to, there's a tremendous amount of confusion out there today about blockchain. And as I got excited about this phenomenon several years ago and started to dig into it, I realized that probably the hardest thing to do is to articulate to smart, sophisticated people what's going on here. And it's the reason, basically, that I wound up writing this book. I was publishing academic research and so forth, but I kept talking to business executives, to smart people in government, folks who understood technology very well, saying, I just don't get it. It's not that I'm skeptical, I just don't get what's going on here. So I spent a lot of time trying to ask myself, what exactly is this phenomenon? Is the important thing that Bitcoin and cryptocurrencies like it, or a new form of money? Is the important thing the technology of these decentralized ledgers? I eventually realized that what was going on was actually something much more fundamental. And there's a lot of deep technical nuance and richness potentially to get into. I'm going to abstract across, in many cases, a variety of specifics about what's going on, because I think really all you need to understand to have a sense about what's going on here is what this basic deep change is, and it all comes down to trust. And the starting point is why this is so important. We are today living through a global crisis of trust. Studies show that trust in government, trust in corporations, trust in the media, trust in all traditional institutions is plummeting. The Edelman Group does a global trust barometer. They do a global survey and release it every year at the World Economic Forum in Davos. And their 2019 report showed that only 1 in 5 people believe that the system is working for them. And the gap in trust between the elites, essentially, and the general populace was the highest they have ever recorded. And look, I don't need to tell you about what's going on in this country and the world, why there is such great erosion of trust and concern. And so what do we do about it? Well, a little over 10 years ago, Halloween 2008, a 9-page paper mysteriously appeared on the cryptography mailing list. And it was written by someone or some group of people using the pseudonym Satoshi Nakamoto. We still don't know who that is, right? He or she might be here in this room for all we know. But we know what the paper says. And this paper was the basic framework for Bitcoin, for this decentralized private form of money or currency. And the question is, well, what was Satoshi doing? Well, Satoshi tells us in the last paragraph of the paper that what Bitcoin was fundamentally about was a mechanism for transactions without relying on trust. Without relying on trust. So the idea, it seems, is that using these cryptocurrencies and the underlying blockchain technology, we don't have to deal with trust, right? Trust is a problem. People can be untrustworthy. Governments can be untrustworthy. So maybe we can just get rid of trust entirely. Use technology, cryptography, and software algorithms to do away with trust. This is the argument you often hear even now from people in the blockchain community. And the conclusion that I reached is, with all due respect to Satoshi, that's wrong. It's not what cryptocurrencies and blockchain actually are. They're not the elimination of trust. And you think about it. Why would anyone find Bitcoin or some cryptocurrency to be valuable without trust? Even though the price has fluctuated tremendously, Bitcoin has been worth more than zero for more than 10 years, even though it's totally based on this open source software run by thousands of computers around the world. No banks, no governments behind it. People find it valuable. That's a form of trust. And if you need further confirmation that trust doesn't go away, just ask the customers of QuadrigaCX. This was the largest cryptocurrency exchange in Canada, a place where you could buy and sell cryptocurrencies like Bitcoin and Ether. Had about 115,000 customers, close to $200 million of customer deposits. Earlier this year, QuadrigaCX announced, we're very sorry, our CEO, Gerald Cotton, died on a visit to India. And then they said, we're also really sorry to tell you, he had the only key. Literally, he had the cryptographic private key to the cold wallet that had all of those $200 million of customer funds. They said to their customers, we've got your money, but it's lost forever because he's dead, he had the key, and we can't find it. Now, the real story actually turns out to be even wilder. It turns out there was no cold wallet. People have done analytics on the blockchain. It turns out that there were a number of wallets, money was siphoned out of them for months. This appears to have been essentially a Ponzi scheme. But the point is, that's an awful lot of trust, right? We're talking about getting rid of trust. Would you trust a bank where if you went into the bank, they said, okay, we're putting your money in the vault over here. We're going to close the door. And then the bank branch president, she's got the key, right? She's the only one who can open the vault. You would never give that much trust to a bank. And yet here are people using cryptocurrencies, using Bitcoin and things like it, who repose that amount of trust in a centralized actor. Now, QuadrigaCX is an exchange. It's not a blockchain in and of itself. It's actually a centralized service that operates adjacent to the blockchain. But the point is, you would think that cryptocurrency investors are the least trustworthy people in centralized financial institutions that you can imagine. These are people who believe in putting their money in these decentralized cryptocurrencies, and yet 80% of them, based on studies, use a centralized custodial exchange like a QuadrigaCX. So trust doesn't actually go away. What blockchain actually does is changes the structure of trust. Trust is not an either or. It's not either you trust something or you don't. Trust has what I call architectures. And there are a variety of different traditional trust architectures, ranging from peer-to-peer trust between individuals directly or between companies directly, to what I call Leviathan trust, basically trust in the legal system, from Thomas Hobbes in the 17th century, who pointed out that we trust in counterparties because we know that if we have a legal contract and they violate our agreement, we can sue them. You can bring the power of the state through the court system to bear to enforce your private transaction. Because you know that recourse is available to you, you're willing to trust in the counterparty. But of course, the problem there is you've got to trust the government, you've got to go through an imperfect and inefficient legal system, and so forth. And the third traditional form of trust is intermediary trust. You trust some central actor in the middle of the network because you don't want to have to go through all these pairwise trust relationships. So all of us give up all of our data to Facebook because they're so trustworthy. If there's anyone from Facebook here in the room, my apologies, but this is a generalized problem. Anytime you have some central actor that has this power of trust, they become potentially a source of untrustworthiness. So what blockchain does, it doesn't replace any of those things, but it creates a fourth structure of trust, a structure of trust which says something very specific. You can be confident about the state of the ledger, the history of transactions, or essentially the state in a computer science sense of the system, everything that's happened, a snapshot of where it is. You can be confident of that without having to trust any particular actor to verify information. You don't need to trust the bank that's keeping track of your money. You just trust in these algorithms and the system that they produce. That uses a set of processes called consensus. There are a variety of different technical mechanisms that have different kinds of trade-offs involved, but all of them typically have the property that they require what's called immutability. So the idea is essentially this is a write-only database. You can write information to the blockchain, but it's extremely difficult, if not impossible, to change information once it's written. Because if anyone could change the information on the blockchain, if anyone could say, I'm going to reverse that transaction, you'd have to trust them, right? You'd have to be confident that that powerful actor did not previously reverse a transaction that happened in order to believe the information that you see. So that's at a very high level what's going on here. The best way to explain this that I found is actually by 3 Australian economists, 2 of which happen to be here in the room today. So they'll tell me if I get this wrong. But I found this to be a really instructive way of explaining this. In my terms, the point is that trust is a cost in transactions. Trust is a benefit. Trust facilitates social interaction and it facilitates business transactions. But trust doesn't just automatically exist in the world. There's a cost to create trust among counterparties. And typically the counterparties have to pay those costs. It's a transaction cost that can stop transactions from happening. And the basic idea with these blockchain systems is essentially it's a kind of three-sided market. There's another set of actors who pay that cost of trust. In a proof-of-work system like Bitcoin or Ethereum, those actors are called miners. They are economically incentivized to do the work that secures the blockchain in order to get rewards. That's actually the process by which the system creates more currency. It's essentially the central bank that's doing monetary policy through the system. But that incentive causes these miners to essentially pay the cost of trust for people who want to transact. So this system, even though it in some ways seems strange and counterintuitive, actually works. And we know this because Bitcoin has been around for more than a decade. It's a public bank vault worth today over $100 billion. Now, you can bet every criminal on earth would love to be able to crack that system, to steal that money, to basically do what's called a double spend, to basically multiple spend the same coins and steal the money. None of them, with a few very early exceptions, which don't really matter, none of them, since this really took off, have been able to successfully come up with a way to break the security of the Bitcoin blockchain. So that's an incredibly powerful thing. That means in a decentralized way, it's possible to create this new form of trust. So what's it useful for? What do you need a blockchain for? Nothing. So this is a slide that may be a little small to see here, but it's a great flow chart. Do I need a blockchain? The answer is no. The amusing thing is who posted this on Twitter. It's someone named Vinton G. Cerf, who you may know is the co-inventor of the TCP/IP protocol, one of the creators of the internet. Now, I put this up here partly because Vint also said some nice things about my book, but also really because he's got a point. There is nothing you can do with a blockchain that you can't, in theory, do with a traditional database. A blockchain is just a kind of database, but it's a particular kind of database. It's a kind of database that has certain advantages, certain disadvantages, but certain benefits. So even though, in theory, there's nothing that you can't at all do without a blockchain, there are many situations where you might actually want a blockchain. And they resolve into two categories. One is sometimes trust is a problem. This is what I've already alluded to. You get these central trusted agents in a transaction. They potentially become too powerful. They extract monopoly rents. They become untrustworthy. But even just as a matter of security, if you've got to trust some central actor, you've got to trust your money to an exchange or to a bank or to some particular company, well, that's a security vulnerability. It's a single point of failure in the system. Decentralizing that trust, having multiple copies of information where there's not one central point, actually makes a system more secure. And the final point is we have these islands of trust. So once trust is centralized, no one provides trust for every piece of the system, it actually leads to lots of friction. So think about what happens if you want to send money across borders. Even within a company, you've got a multinational company wants to move a bunch of money from its treasury in Kenya to its affiliate in Canada. It can't just do that directly. Because again, there are these islands of trust. It's got to go through a network of correspondent banks that have to have collateral against the transaction between the currency pairs, different steps that have to happen to the point where that transaction, again, even still within the bounds of a company, takes several days and costs a substantial amount of transaction fees. So the idea of one blockchain platform was we could potentially eliminate those intermediary friction points by having one shared source of truth. The second side of this is sometimes there's just not enough trust. So anytime multiple companies have to work together, which is basically almost any business transaction, there's a gap in trust. So think about just a simple buyer and seller. They're each going to keep their own records. They are each going to keep information about the same transaction. Neither one is willing to say, all right, I'll trust you. If your records say you got what I shipped, that's fine. If your records say it didn't get it, okay, I'll just resend it to you. No, the buyer and the seller are each going to want to keep the information because they don't fully trust each other. And sometimes those records, those ledgers may become out of alignment. There may need to be a reconciliation process, which is costly. It leads to possibilities for errors and so forth. Now multiply that across $5 trillion that goes across global supply chains every year, and think about the mass of inefficiencies that get produced. The potential of blockchain is, again, one shared source of truth. Everyone agrees to use the same ledger. They keep control of their own information, but they're able to trust the blockchain as opposed to having to trust each other. That potentially is much more efficient, also allows the blockchain itself to be the source of truth for auditing and regulation, and it becomes a platform. So these are not just flat, static files. The blockchain is made up of these computers that are constantly verifying the network. You can think of the blockchain as a kind of operating system, as a core layer, a foundational layer of a global decentralized computer. And then it's possible to think about writing applications that run on top of that decentralized blockchain computer using something called smart contracts, which is basically expressing transactions and expressing computer code that runs as an application immutably across this blockchain platform. So that's the potential here. That's what's so exciting. But I'm a legal scholar, so I deal a lot with what happens when things go wrong. And the reality is there's a lot that can and does go wrong here. First point, it's an incredibly immature technology. Again, the Bitcoin white paper is 10 years old, but Bitcoin was just the early, initial, more limited version of this. It's really only 4 or 5 years at most since we have production systems that do these more sophisticated smart contracts at all. And in many ways, they're very immature. There's lots of security breaches and problems that are still coming up. And we have this trust problem, the problem you saw with QuadrigaCX. So you might be able to trust the blockchain, but you can't necessarily trust the party on the other side. You can't necessarily trust the information that got put in the blockchain. So one of the big things that happened that led to this explosion of cryptocurrency prices in 2017 was these ICOs, initial coin offerings. Companies raised money by issuing cryptocurrency tokens. The blockchains work just fine. You could be sure that you actually got the token that they said you got. But you could not be sure that the one you paid the money to for that token did not take the money and run. Wall Street Journal found, just by reading the white papers of the ICOs, and these, by the way, ICOs raised about $20 billion from people all around the world in just a year and a half. They found that reading the white papers, about a fourth of them were obvious scams. Literally, like you just read the white paper and look at like the pictures of the executives at these companies, they were all like stock photos. All right, clearly, and just read the impossible claims, 100% compounding returns annually and so forth. The blockchain does not necessarily provide for that trust around the edges. And in my book, I talk about this in terms of what it means for law. And I talk about what I call Vlad's conundrum. Vlad Zamfir is one of the key developers of the Ethereum Foundation, and he points out that there's this problem. Because if we have these immutable transactions, what does that mean for the legal system? If the blockchain says this transaction has happened and no one can reverse it, then what happens if it's money going to a terrorist group and a government says, no, you can't do that? That's illegal. Stop it. The blockchain provides no mechanism for that. So it seems like we have to choose. Either we have law or we have this blockchain system. And there's a similar problem around governance. So either we have mechanisms where centralized actors decide what to do and how to evolve these systems, or we have this decentralized environment where no one has power. Turns out, fortunately, it's not quite that bad. So I said trust is not either or, decentralization is not either or either. Decentralization is a parameter. Systems can be more or less decentralized along different dimensions. There's value to decentralizing, but there also are costs. And it turns out that one of the costs is the more decentralized you make a system, the harder it is to use. The harder it is to make it into something that lots of ordinary people, that a mass market will adopt. And that's why so many of the big, massive internet platforms are platforms that are centralized walled gardens, because they're able to make things that work really well and are really easy for people to use. And so what we're seeing is that even though this technology, in theory, totally decentralizes everything, there are still hooks. There are still points of centralization, places where it's possible to do legal enforcement. A number of these decentralized exchanges have either had to close down, or governments have come in and said, you need to do a know your customer check. Just as when you open a bank account, There's a verification process to stop money laundering, to stop money from going to sanctioned countries like North Korea. A similar thing has to happen, not again with the blockchain itself, the decentralized layer, but with these applications like the exchanges, the on-ramps and off-ramps into the system. And so that's what we're seeing right now. And my contention is the people in this blockchain community. You hear a lot from these early adopters who say, oh, we don't need governments at all. The reality is most people want something they can trust. They want something that is stable, and regulation is a part of that. That's why, even though the US is not by any means the least regulated financial market in the world, it's probably the biggest and strongest. And part of that is because it is well regulated. People know that there is a system standing behind their transactions. There is also a role for technology to help here. I won't get into the details, but there's really interesting experimentation on a number of these platforms using similar kinds of mechanisms, similarly the way the blockchain decentralizes using technology, the verification of transactions. It's possible to think about using decentralized mechanisms, combination of cryptography, computer science, and economic game theoretic incentives to make these kind of decentralized governance decisions, to have, for example, voting systems based on the cryptocurrencies and incentive systems for people to provide accurate information. Really interesting, exciting area of development, still very early, but with a lot of potential. So ultimately where this leads to is that for these networks to work, for them to reach their potential, they need to be effectively governed. Because that's what blockchain does. It's a governance technology. It's a kind of a legal technology that uses these components, the cryptography and the computer science and the economics and so forth, to produce order in a decentralized way. And there are a variety of different mechanisms that come into play that are valuable in effective governance. Law is one of them. Economic incentives and self-interest is one of them. The guarantees you get with cryptography, where it's really hard to reverse a transaction because it is cryptographically secured, is another piece. And trust is the piece as well. Trust is ultimately people's willingness to believe in something. And that's not necessarily reducible to some formula. Because the reality is, if you go and look at the literature on trust, there's a big academic literature on trust, it turns out, in 4 or 5 different disciplines. And it all converges to the recognition that trust is not just confidence. If I hold a gun to someone's head, I'm really confident in what they're going to do. I don't trust them. Trust actually requires some level of vulnerability. It's only because I don't trust them that I need to take those extra measures. So for something to be trusted, there has to be a kind of leap of faith. There needs to be enough confidence and enough ability to see that the system seems trustworthy for there to be a willingness to act. So ultimately, there's a human dimension to all of this. And that's less precise than just looking at the cryptography. But it's also much more exciting because we're basically building new kinds of institutional systems that can, again, apply all across society in so many different ways. So that's where we are today. It's still very early. We tend to think because there's so much money that got thrown into cryptocurrencies and blockchain that this is like the dot-com bubble of 1998, 99. We're probably much earlier. The potential is there. I think this is a technology that, like the internet, could someday touch every business on Earth. Because everyone has to deal with these trust gaps and these trust problems. But right now we're in a really exciting stage of experimentation where different kinds of blockchain systems are being tried, different kinds of governance systems are being tried. We're finding that fit between the applications and the technologies. And I don't know exactly how that's going to shake out, but I think you don't want to ignore this phenomenon. Because as the markets start to mature and as the applications match up with the capabilities of the technology, this is something that's going to get adopted widely all across the planet. So with that, let me stop. Really happy to be here and glad to take some questions from Mark.
Great, thanks.
Thanks.
So, give me a sec, Pitt. Can I? You want to get you? Do you want? Well, let me get going a little bit, and then we'll come to you, Pitch. But I was just going to say actually that I would I'll ask a few questions and then open it up, and then I've got plenty that I can ask, but I really want to. This is such an interesting topic and different from what we usually cover at SIEPR.
Warriors in 6. How about that? Warriors in 6. Okay.
Warriors in 6, right? That will make you popular around here. So let's see. It's interesting. I mean, we had our last speaker was the head of something called the FDIC, which is regulates banks and having sufficient capital, deposit reserves, and so forth. But it's interesting because FDIC plays a big role in regulating the financial sector, but there are other government agencies that regulate the financial sector too. And I'm just curious, as you sort of think about the blockchain and as it gets going, what should policymakers be thinking about as they try to maximize the benefits from this thing while minimizing the harms? And whose responsibility would it be? Like in the sort of regulatory apparatus? Is it the Fed? Is it like who? Or is it still very much up in the air how that's going to go?
Yeah, well, it's a very horizontal technology. So it depends what kind of application we're talking about. So for example, if we're talking about things like initial coin offering, so a firm is going to raise capital by issuing some sort of instrument, well, that's a Securities and Exchange Commission kind of issue. If you're going to have some sort of financial instrument that you're going to trade a derivative on, a future or an option around this, you're going to create a marketplace for people to essentially bet on the future price of Bitcoin. Well, that's a commodity market. We've got the CFTC, the Commodity Futures Trading Commission, that regulates that. If we're talking about some of these law enforcement, money laundering type issues, well, we've got FinCEN in the Treasury Department that deals with that, Department of Justice that does law enforcement, and on and on. So really the question is, all of these agencies, certainly all of the financial ones, I think, have a role to play here. But even other ones. I mean, there are consumer protection issues here, which in the US is the jurisdiction of the Federal Trade Commission. So really every government agency needs to think about, first of all, how does this potentially affect our mission? But also, how can we leverage this technology? How can our systems take advantage of this kind of ledger? Because a lot of what government agencies do is record keeping, is basically say, we're going to keep the records of your property holdings, of your assets, of your identity. We're going to issue you your social security number, your birth certificate, and so forth. All of those are things where blockchain is potentially a very powerful technology to enhance what they're doing. So it's a standard thing, and I talk about it some in the book. It's first sort of dividing what are the easy questions and the hard questions. There's some things going on that are clearly illegal and clearly should be stopped. And there's some things where there might be room to sort of watch the market as it evolves. And then a lot of collaboration. I run a workshop on blockchain regulatory issues with regulators from all around the world. They're interested in talking to each other. And to your point, the ones from the United States are often interested in talking to the other US regulators because even though they're all in Washington, they don't necessarily collaborate as much as they should. So I think that's healthy. I mean, I think there is some value in regulatory competition. It's also happening at the state level in the US. There's interesting experiments going on in the states, and they also look overseas to things that other jurisdictions are doing. I think we have some time to work this out as long as the regulators are sort of moving forward and thinking it through.
Right. Okay, that's great. Very helpful. Have there actually been any laws enacted, regulations put in place that are focused on blockchain?
Yeah, so in the US, not at the federal level, although there's guidance. So a lot of this is administrative guidance. So for example, FinCEN, which is the regulator of things like money laundering and terrorist financing in the US, back in 2013 issued guidance to say, look, we deal with things that work like money. And this is not a traditional currency issued by a government, but you're using it like money. And so if you use a cryptocurrency, then you are subject to the same kinds of rules as other money transmitters. So some of it is just this administrative guidance. There's various legislation floating around on Capitol Hill. But again, really where the action has been in the US is at the state level. And not always where you'd expect. So actually the most advanced jurisdiction in the US, and I would argue by some measures one of the most advanced in the world, is Wyoming. And why? Well, Wyoming is a small jurisdiction where a little bit of economic activity goes a very long way in the state economy. And if they can get some amount of this blockchain and cryptocurrency activity to be located there, just as an economic development phenomenon, get companies to locate there, it makes a huge difference. And it turns out that one of my law school classmates, a woman named Caitlin Long, spent 20 years on Wall Street and then got blockchain religion, worked for a blockchain company, and then went back to her home state of Wyoming and said, I'm going to work with the legislature there and craft a whole series of regulations. So they've got 13 bills they passed in Wyoming dealing with all different aspects of this in really creative ways. Some of it is just relevant to Wyoming, but some of it really will be a model for the nation.
Great. So thinking of this like an economist, so here we've got a new technology. I want to think about, let's say, the economic impact. And we talk, for example, about the internet. You mentioned the internet earlier. And when the internet was getting going, you could kind of see that certain occupations, certain industries were going to be differentially affected. So you heard a lot in the early mid-90s about travel agents. That travel agents, it was likely, that was pretty clear that was going to change quite a lot. Similarly, when you had sort of growth in robotics, pretty clear that like the manufacturing sector would get hit, in good ways and bad. Can you give us a sense of the kind of heterogeneity in the economy, like how this blockchain technology, where should we look for effects? I'll just give you another one. I'm right now collaborating with someone trying to get going on an autonomous vehicles project. And what is the economic impact of that going to be? And we can think about taxi drivers, people who drive trucks across the country, delivering cargo and so forth. Can you give us a sense just if this technology starts to grow, how you see its economic impact playing out?
Yeah, so it depends at what level you're asking. If you're asking at the level of sectors or companies or at the level of individual jobs. So certainly financial services is a big one, where even if we're not talking about the cryptocurrencies, we're just talking about the platforms. You talk to people on Wall Street, and for all the advanced technology that they have and for all the incredible speed and scope of our markets, you sort of look a little bit below the surface. And you've got literally people sending millions of faxes to India to be transcribed, to be the back end for a lot of these transactions. Because of exactly the problem I talked about, because you have people who have to collaborate on the same transaction who don't trust each other, so they've got their own set of records. Even, for example, you've got a syndicated loan where every party is calculating the interest rate independently on the same loan. So there's a huge amount of overhead that produces. And so, and that gets multiplied across sort of everything in financial services. So we can certainly see that, but you step back at the industry level. There's a paper that I cite in the book that did a longitudinal estimate of the cost of financial intermediation across something like 500 years. And you might think that financial intermediation is thousands and thousands of times cheaper than it was back when we were doing things on paper, but the conclusion of the paper is actually, no, it hasn't changed. What's changed is the market is much, much bigger. We're doing far, far more sophisticated things than we were doing back in the days of the Medicis and the Rothschilds and so forth. But as the existing intermediation functions have been commoditized, the intermediaries have figured out ways to move up the stack, to do things a little bit more complex and a little bit more sophisticated. So I think that at a general level, that's going to happen. But yeah, at some level, it's similar to what you described. So the people working in law firms who are doing nothing more than rewriting existing contracts and basically not adding any value, that can be done in a much more automated way. But there's still going to be a need for people who understand how legal systems work. Kind of legal engineering is still going to be even more valuable than it is today. So there certainly are these transition questions in terms of for people who work in these industries. But really, sort of to answer your first question, you just sort of it's the Willie Sutton thing with banks. Why do you rob banks? That's where the money is. You look at the biggest industries, so things like shipping and logistics, as I said, $5 trillion, transportation, financial services, all of these industries where there's so much activity. I think those are the ones where you're going to see ultimately the most transformation, because it's the biggest difference that can be made using these common platforms.
Great. So, and when it may be hard to get data on this, but I wonder, do you have a sense of whether there are certain companies that are going into this especially aggressively, like big companies, and or countries that are trying, you gave the Wyoming example,
Yep.
which I was not aware. That's
Yep.
great. That's a great example.
Yep.
But and on the opposite side, we had here last year Jamie Dimon, who has said a lot about
Yep.
Bitcoin and especially Bitcoin.
Not a popular guy in Bitcoin circles, yes.
Right. And so are there people, or countries or companies on the opposite end that are sort of trying to do what they can to prevent it, to impede it, to slow it?
Yeah, so Jamie Dimon is an interesting example in terms of what he has said is he's tremendously skeptical of Bitcoin, of these cryptocurrencies themselves. I think it's just a scam. But he's actually very optimistic about the underlying blockchain technology. And in fact, JP Morgan is investing huge amounts of money in the infrastructure. They've actually created their own internal, it's being called JP Morgan Coin, not to be traded as a speculative asset or to replace money, but for internal payments, for the kind of examples that I described to you. Even as their own internal service, there's so much inefficiency moving money around between these different islands of trust. So that's one point. But to your question, there is a lot of skepticism. There are places that are worried about some aspects of this. You often hear China brought up as an example where China has banned initial coin offerings, they've banned cryptocurrency exchanges, but you then drill down below the surface, you look at what's actually happening in China. China is actually one of the, if not the most active blockchain and cryptocurrency markets in the world. There's a tremendous amount happening, and a lot of it is actually promoted by governments. China's concerned about, for example, people speculating in ways that will lead to social instability, just people gambling away their money on some of these shady blockchain or Bitcoin or cryptocurrency-based products. They're worried about capital flight, where people will change their renminbi into a cryptocurrency to evade their capital controls. But they're not worried about innovation. They actually see this as potential. They're actually looking at tokenizing their own currency, using a private cryptocurrency for their fiat currency because they want to get the advantages of this digital global technology, and they can also get visibility across all of the transactions. So I don't think there is any place that I would say is putting up a big stop sign saying don't do this, but different countries are in different positions. So if you're a small country like an Estonia or a Dubai or a Malta, like Wyoming in the US, you can push forward very aggressively and say, come do your transactions here. We're going to put our whole government on the blockchain and so forth. That's not particularly relevant as a model for the United States. So the larger jurisdictions that have all of this complexity involved, it's basically what I was talking about before. You've got to sort of drill down on particular questions, what's happening. But no, I would say we're seeing different approaches to this, and there are different things that jurisdictions are concerned about. There are some that are more or less aggressive. I actually think the US is really lagging not in regulation, but in being strategic. I talk to people in governments in other jurisdictions, in Europe and other places, and they talk about their blockchain strategy, where they're pulling together all these agencies to work through their differences, to figure out, okay, how can we use this? What do we need to worry about? What is the industry doing? How can we promote activity in our jurisdiction? And we're just not doing that here. There's not that level of collaboration. I think that's really the biggest threat to the US.
Great. And I wonder who would be the natural person to lead it? Like who would be
I think you'd be great, Mark. Yeah. Although I think it sounds like you got a good job here. But to lead what? So
who would be the natural sort of champion?
It's not to be a blockchain czar. No, so I don't know like a particular person. It's more having the authority. So when I was in government in the Clinton administration, I worked on this thing that became called the Framework for Global Electronic Commerce. It was a working group led by Ira Magaziner. And Ira Magaziner, very smart guy, but he was basically a friend of Bill Clinton from college, who at this point he tried to do healthcare reform, something you're quite familiar with, and they failed that time around. And he was literally trying to find something to do in the White House, and he seized upon, well, we need rules for electronic commerce, and the fact that he had the ear of the president and vice president, and could put out this call within the government, and it was a very tech-savvy administration. I remember I was at the FCC, and so I was doing the internet policy work there, and so I would get called to these White House meetings for this working group, And 1 week it would be, okay, let's get everyone in the US government together who knows anything about internet privacy. It'd be like 12 of us. And then like a month later, it'd be like, let's get everyone in the government who knows anything about intellectual property, copyright, and trademark issues online. The same 12 people, all right? That's how early it was. But the fact that there was that effort to pull everyone together, it's just someone with that level of authority. There are lots now of companies, of trade associations. There's a community that's building in this area in the private sector that wants to help.
Yeah.
I mean, there's some people, of course, who just want to evade regulation, but there's some reasonable actors who understand that it's better for government to get it. So really, it just needs that spark of someone who has that authority.
I think a lot of enthusiastic, believers in the blockchain have been surprised that it hasn't sort of taken off more quickly and more extensively. You hear sometimes statements like blockchain hasn't lived up to the hype. Can you give a sense of what, are you surprised by how things have evolved, that like some would call slow pace or not? Yeah,
so I'm glad it hasn't lived up to the hype because the hype was crazy. The hype didn't make any sense. You actually spin out the implications if we all suddenly got rid of using dollars and started using these cryptocurrencies and these decentralized applications at a time when they were so immature that all these systems were vulnerable to breaking and hacking and everything. So yeah, there's no question that the hype got ahead of itself. The funny thing about writing a book is that there's this lag. So I wrote the book, I turned in the final draft of my book at the very end of 2017, which is right in the middle of this bubble. And at that point, I was thinking, well, this can't go on forever. And so I'm trying not to get fixated on it, but it's sort of, I felt like I was this huge contrarian being so negative. Well, we have to deal with these problems of trust and these problems of law and governance. Book comes out about a year later at the end of last year after this cryptocurrency crash. And people say, well, how can you still be optimistic about this thing that's so terrible and it's not going to take off? So there's some of that in any kind of technological revolution. And I think the important thing is, to sort of step back and say, what's really going on here? What's enduring? What are the fundamentals? And we can use economics to understand that. We can use legal concepts. Use lots of mechanisms. And once you step back and do that, if you are a player in the market and you're making a financial bet, you want to have a sense of when exactly something's going to happen. But if you're sort of directionally saying this over at least the next phase of my career is going to be a really significant technology that's going to touch everyone, then I have really no doubt about that. And actually, in some ways, this is going slower than people realize. In many ways, it's going much faster than people realize. You go talk to almost any major corporation, even, again, I gave you the Jamie Dimon example, places where the executives publicly are being very negative, I guarantee you they've got a blockchain project somewhere. Because again, people are saying this solves a real problem that we have, and it will take time for it to mature, but it's real.
Great. Okay, so with that, I'd like to open it up for some questions from the audience. Pitch raised his hand first, and then we'll go to Jeanette. Pitch, you've been very patient. Thank you.
Are there different kinds of blockchains, and can you use any cryptocurrency? If so, can you use any cryptocurrency on any kind of blockchain?
So there are different kinds of blockchains. There are two broad categories. There are what are called public blockchains, where anyone can join the network, and what are called permission blockchains, which is what most of these enterprise applications are, where they say only if you're in this consortium can you get on the network, and then it's decentralized across that. But there are many other subdivisions, many different approaches. A blockchain does not have to have a native cryptocurrency, is the first thing. And it's possible to have multiple cryptocurrencies that are essentially like a virtual coin on one blockchain. So the biggest example of this is Ethereum, which is the second most valuable cryptocurrency, the Ether cryptocurrency. The Ethereum network has a standard to create a new token. So there are something like 2,000 or more cryptocurrencies out there. The vast majority of them are actually running on top of the Ethereum network. You don't need a separate blockchain for every cryptocurrency, but what blockchain you use determines the characteristics of the network. It determines the capabilities of the tokens on top of it. The question you're asking, though, is really about interoperability. So it's not necessarily a matter of do you use a different currency on the same blockchain, but can we have some mechanism for that to interoperate? So something that happens on one blockchain gets mirrored on another blockchain, or I can do a transaction back and forth. And this is, governance, as I described, is one big area of development. Interoperability is another huge area of development. There's a variety of technical mechanisms where you can have multiple blockchains that work together. And ultimately, this is going to be a network of networks. Not exactly like the internet, but the internet's a federation of all different networks that use a common protocol. It's not exactly the same, but I think we're going to see more and more of these mechanisms because, yeah, it doesn't make sense to have totally separate and distinguished blockchains for everything. For some applications, yeah, if you just want to do a blockchain in this one unique context. But really, the value comes from getting entire ecosystems onto these platforms. Sure.
Great. Jeanette.
Well, I'm going to hopefully ask a question that at least sounds like an economist asking a question. Going away from the technical factors for a moment, going back to the essence of this. You talk about the new architecture of trust. You talk about this being distributed trust. So this makes trust sound like a thing, a loaf of bread. And if we're going to make decisions about what to do on this, that must mean we know how to value trust or how to put a price to it. How do you guys, I'm pulling you in on this, Mark, all right? I mean, how do people assign a value to trust? I have never been able to figure it out. I'm in the business of it. People will say time. That doesn't make any kind of sense. So what is it that people assign a value to on trust so that they can understand how they want to pay for it to be distributed?
That's you. I got
no, it's a really good question, and I will give the caveat that I'm not an economist. I just play one at SIEPR and on TV, but obviously I do teach at a business school and I'm conversant. So there may be more of an economic literature that maybe even other people in this room know about. But I guess what I would say is yes, it would be nice to be able to quantify it and value it, and that would be an interesting research experiment. Once we get transaction data, once these networks are more widely adopted, then I think we can actually do experiments. But really, for me, it comes down to sort of if the trust is sufficient, then the transactions happen, and if it's not, that they don't. So you can look at what it takes to sort of get over that hump, and that's not giving you an exact number, but at least it's allowing you to see something, and it's going to be very domain specific. So it's not that like the value of trust is $6 or something like that. There are going to be other dimensions to it, and so I don't think I have a precise answer. I think it's a very good question, and one of the things that's useful about this, again, I was talking to the guys from RMIT in Australia that are here. Is that this is a great opportunity for experiments to actually have these systems be constructed, and then real people are going to make real decisions with real economic consequences around them in ways that before we just had to sort of rely on, okay, here's what the world and law and governments give us. But now I think we're going to be able to compare different kinds of systems, and so there's some very sort of rough cuts one can make looking at the performance and the uses of these different blockchain networks, but I really think it's sort of too early to make conclusions, but I think going forward we'll be able to do more of that.
Great. I've got another question right here.
Yeah, hi, I work at an investment management company. We've been exploring the applicability of blockchain in our business and have been speaking with other LPs like us about the potential of utilizing blockchain to smooth our investments in funds. And just curious whether you've heard of this idea from others or if you've seen that application currently.
Oh yeah, so absolutely, sure. And there's a whole there's so many things happening and so many examples in all these industries that I don't claim to be an expert on any of them. But certainly in terms of the investment management process, there's for example, there's a whole decentralized smart contract platform called Melonport for asset management, where they've actually sort of built this in as a set of smart contracts that taking into account the legal requirements and what you need as an asset manager, and have sort of built that and actually decentralized it out to a council to run it, again with the hope that it is able to do these transactions more efficiently. So the short answer is yes. But as with any of these things, it's sort of actually building it to be workable, to plug into all of the legacy systems is not trivial. But that's, so I mean, I don't have a good precise example in terms of your use case, but this is definitely an area where there's a lot of effort going in this direction, both from the established players, as I said, companies like JP Morgan, as well as lots of startups that are thinking, this is an opportunity to basically reinvent the process of what we do, a lot of which is just record keeping and compliance about moving things back and forth. You can, in theory, do that in a much more efficient way. So that's definitely happening.
Okay, more questions over here. Joel. Wait, there you go.
To Jeanette's question, it would seem that the value in trust has very little to do with distributed ledgers and more to do with the immutability of the ledgers. Mm-hmm. What's the benefit of having it distributed? Because there's a cost that goes with that.
Oh, well, so that goes to what I was talking before, that it's the problem of trust if it's not distributed, is either you have a central trusted actor, which is problematic in various ways, or you lack a central trusted actor and then parties aren't willing to transact. So the distributed nature of the system is what lets you trust the system as a whole without having to worry about this problem of everyone having central control of information.
Okay, therefore the follow-up to Pitch's question, if you're going to have interoperability, you need some sort of governance over that to make it work. If you're dealing in cryptocurrency, you need exchanges. And the exchanges thus far are not secure.
Yep.
In the existing financial system, we have regulation to provide that level of governance. Wouldn't regulation equally apply to immutable ledgers, whether they're distributed or not?
Yes. So, now is it exactly the same regulation? Not necessarily. Are there sort of new aspects of this that might require regulation to evolve? Is there room for self-regulation, co-regulation, all these things? Absolutely. But those are the problems that have to get worked through. But no question. These systems are not going to function reliably and in a trusted way in a pure Wild West environment. That's the point that I take as well from a lot of these examples. And I think that's what we're starting to come to. There's sort of a knee-jerk reaction among some of the early cryptocurrency people that sort of regulation inherently will throw a monkey wrench into all of this. And now they're starting to recognize that actually our customers like to understand that there's something back in this. It's not one of these actors that might go take all of our money. The question is figuring out where regulation is actually still necessary here, and where legacy regulation made sense because we were dealing with things historically on paper, and maybe certain things aren't needed anymore.
Okay, we have another. Okay, we've got one there, and we have one over here. And I think then that's what we got time for.
So since blockchain is a way of storing data, I think some people are talking about blockchain potentially being an effective way of keeping track of medical records or voting records. And since you have a legal background, what do you think about the relationship between blockchain and privacy and potentially using that for medical data and voting records?
Yeah, so these are applications that people have been talking about for a while. At some level, they make a great deal of sense. They're really hard. And they're hard partly for the privacy reasons, regulatory reasons, in the healthcare space. There are so many problems. It's not all that different from, again, 20 years ago, I think it was Jim Clark, I think the founder of Netscape, his next company said, okay, we're going to solve the problem of healthcare by creating these digital health records, and we're going to put it all on the web, and that's going to solve everything. And they spent just a huge amount of money and just gave up. Because it turns out that even though you can draw a piece of paper and say, well, wouldn't it be great if we had one decentralized ledger for all this medical data, implementing it in practice, you run head on into all of the challenges that make healthcare so messy and so hard. So that's not to say there isn't anything that can be done. Blockchain certainly, I think, can provide some value in that space, but it's not simple. And voting is the same thing. There are people who say, well, we've got this problem with election security, let's just put it all on the blockchain. Virtually every voting security expert who has looked at this has said, you know what, that's not the problem. The problem is not just saying once information is recorded, having it be secure. Like we know how to do security on a centralized database of voting information. It's who has access. It's how secure are the voting machines. It's what happens after the votes get cast. It's all of these things around the ledger itself. So that's one where, again, yes, this technology could play a role. But the question is really, is the problem that needs to be solved the kind of trust problem I've described? Where, again, there's this gap in trust or there's some trusted entity that's problematic, or is it really something different? And both of those examples you gave, I think what we've seen so far is that the fundamental problem, and they're really important problems, is not the problem that blockchain seems well suited to solve. I think it'll be a component of the solution, but it's going to take a long time to really be useful.
Okay, we're going to try to one quick one, because I know we're a minute over already.
Sure.
But one final question.
So I found the miners and the whole blockchain process very interesting, and I was wondering, it seems like human miners already use their computers to generate a working hash to verify these transactions. But is there a possibility that in the future the computers could verify the transactions themselves, eliminating the need for these human miners? And just, I guess, a side question is how do people prove that they're familiar with algorithms and can be a miner? Like, do they pass a test or do they get a license?
Yeah, so it's not, it's a computer today. So, I mean, there's a human that owns the computer. There's a human that sets up this mining rig or this mining pool to make money. But that, the human is making a decision in terms of what miners they're buying and what cryptocurrency they're mining and so forth. But then the computers are the ones doing the work. The miner doesn't necessarily need to understand. This is not like a difficult programming problem. This is essentially reversing a hash. This is essentially just running through numbers really quickly, where the more processing power, what the human has to do is figure out their expenditures, the depreciation on the mining equipment they buy, the electricity costs, and all the price of the cryptocurrency, figuring that out to decide what kind of investment to make. But the general point, though, is this proof-of-work mining system has all sorts of problems and inefficiencies, wastes massive, massive amounts of energy, potentially subject to capture and consolidation and so forth. So there are different blockchain networks that use either variants of it that are designed to be less concentrated or that do away with the mining entirely. And I actually think that for the cryptocurrencies to reach their potential, we are going to have to move beyond that mining process because of all these different problems. And so there are networks that use what's called proof of stake, where essentially it's basically a game theoretic system where the cost that you are paying is essentially you stake your currency, and if you're cheating the system, you run the risk that it gets lost. Your currency gets slashed. So you have an incentive to be accurate. There's all kinds of complexities about how to do that accurately and effectively. And it doesn't have the track record of the blockchain, the Bitcoin proof of work system. But I think that's likely to be really the future of all of this. The proof of work system actually works, which is the big thing, and it's not going to go away. But I don't think it's going to really scale.
Okay, with that, please join me in thanking Kevin
Thanks.
Werbach.